Hi. In the previous video, we discussed the minimal risk asset. We discussed what it is and how it depends on the currency you're investing in, and that if you're investing in a currency with highly rated government bonds, then that's an excellent choice for finding the lowest risk investment you can possibly get your hands on. If you haven't watched it yet, go check out that video. It's the first in this sort of mini minimal risk asset series. In this video, I'm going to be talking about how you should try to match the maturity profile of that minimal risk asset to the time horizon of your investment. I'm also going to be talking about how much money you can expect to make from your minimal risk asset, the returns you can expect to make, and how you practically go about making that investment. My name is Lars Kroyer. I'm a former hedge fund manager who's written a couple of books about finance, and I'm now doing these videos as a hobby. In most cases, when we're talking about minimal risk investments, the assumption is that we're talking about shorter term bonds. Longer term bonds have greater interest rate risk, which means that its value fluctuates to a greater degree with changes in interest rate, and that it's not clear that all investors need to take that longer term interest rate risk. And the lowest risk is for them, therefore, the shorter term, not the longer term bonds. So here's an illustration of the bond interest risk and why longer term bonds are riskier. Imagine you have the scenario where you have a 1-month bond and a 10-year bond. Let's say they're both zero coupon, so they don't pay interest but pay the full amount back at the end. Let's say they're zero interest rate and they both trade at 100, so they're both worth 100. Now, let's say interest rate goes from 0% up to 1%. The value of the 1-month bond goes from 100 to 99.9, whereas the 10-year bond goes from 100 to 90.5. So this illustrates that there's much greater interest rate risk in the longer dated bond, the 10-year bond, than in the 1-month bond, which is consistent with the greater risk of longer term bonds that we just discussed. So while much of the conversation about minimal risk asset refers to short-term bonds, in reality, most of our needs are for longer-term horizons. We may be needing a minimal risk investment 5 or 10 years into the future, and it doesn't really help us to be talking about 3-month bonds. And what you should do in that case is you should buy what's called an access product. So an access product will be something like an exchange-traded fund that has a range of roughly similar to our exposure. So there will be exchange-traded funds from providers like Vanguard, iShares, State Street that'll have titles like UK government bonds 5 to 7 years, or 10 to 12 years, or 20 years into the future. These companies are much better able to create that exposure than you yourself are. You're typically not set up to deal with the administrative headache or the effective trading of these government bonds, and these providers are for a pretty cheap fee. We're talking 0.1% a year, something like that. You can so what you should do is you have your currency you're investing in, you have your time horizon. Go look around for the right kind of access products. Again, it'll be Vanguard, State Street, iShares. It'll be in the currency that you're after. You can also do a mix of a couple of maturities. It could be that you have some capital needs in 5, some in 10 years, and some in 25 years for retirement, etc. And it's perfectly fine to do a couple of them and sort of matches your cash needs. So that's a great way to go about doing it. It's a great way to create the exposure and match your time horizon. What you have here is in this slide is a chart of the current U.S. government bond yields. You can find the same kind of chart for UK, German, Japanese, and other government bond yields if you just Google the appropriate searches. On the y-axis, you have the percentage yield. On the x-axis, you have the years to maturity, so from 1 to 30. The blue line is the nominal interest rate, and anyone with even a peripheral interest in finance will know that this is at or near a historic low, which obviously isn't great, but there's not a whole lot you can do about it. The real rate, so this is the post-inflation rate, is the orange line. As an example, for a 10-year bond, you can see that the yield is around 2.5%, the nominal yield is 2.5%, whereas the real yield is around 0.5%. This is obviously only US government bonds, but for the other major currencies, the real yield is roughly similar. So if the earlier charts have left you with a sense that the returns you get from investing in U.S. government bonds is somehow stable, I'd urge you to reconsider. In this chart, you have the inflation-adjusted returns from investing in U.S. government bonds since 1929, so since the Depression. The red line is the 10-year maturity bond. It's been around 2% average per year, whereas the blue line, which is sort of hovering in there behind the red line, is the 3-month maturity bond, which is 0.5% average. So what you can see is that the value of those bonds move around dramatically year to year, but they move around a lot more for the long-term bonds. This is because, as described earlier, those longer-term bonds move far more in value as a result of changes in the interest rate. Although with this long history, there's probably also some credit risk at certain times. If you're of the view that U.S. government bonds and the other major government bonds are without risk, I'd highly encourage you to read a book called This Time is Different. That book basically makes a mockery of the fact that government bonds don't default and show how they actually do so with huge frequency over the past many years. The reason I use U.S. data is there's just more of it. It's easier to get. It's not that I'm particularly U.S. focused in this video. This similar logic applied to the other major currencies I've discussed previously. So there are, again, a few things to note from the charts I just showed you. One is that the real return expectations from the minimal risk asset these days is at or near a historic low. There's not a lot you can do about that. That's a market. It'll all likelihood change significantly into the future, just like it has in the past. But for now, it's pretty damn low. The other thing is that you should expect particularly longer dated bonds to vary quite significantly in value. They have historically, and they probably will again in the future. Be ready for that. Even if you're highly likely to eventually get repaid, the value in the interim of those bonds can change quite materially with inflation and interest rate changes. Finally, it's an obvious point to some, but you will most likely, overwhelmingly likely, make greater returns from longer dated bonds than you will from shorter dated bonds. So if your investment horizon is 30 years, you'll typically be much, much better off investing in a series of longer dated bonds than to constantly roll over 3 months or 6 month bond exposure, even ignoring the administrative and headache and trading costs from that. So in summary of this mini minimal risk asset series, if your base currency is one that has great credit quality government bonds available, so this will be US dollars, sterling, euros, and yen. It'll potentially change in the future, but for now that's the case as of March 2017. Then that's a great choice for your minimal risk asset. If your base currency is not one that offers great credit quality government bonds, you have a bit of a tougher choice. You can either take currency risk and invest in those with great credit quality, like the ones I just mentioned, or you can take credit risk and invest in your local government bonds. I'd encourage you to think pretty hard about what would happen to your other investment assets or your overall life if your local government defaulted. It's likely to be very bad news, and maybe foreign holdings would offer some respite. The third thing I want you to think about is that if you have no risk appetite whatsoever, these minimal risk assets, that is your investment portfolio. You would need to just invest in the securities that again depend on your time horizon and your currency. If you want no risk at all, this is what you should buy. But the minimal risk asset is also a critically important component of an overall investment portfolio because it's sort of the base on which we can build a riskier portfolio. In some other videos, I've talked about how you construct portfolio with a world equity index tracker, but the minimal risk asset is a critical component of that because it's where you can adjust the risk that you desire. So if you desire no risk at all, you buy a lot of minimal risk assets or entirely minimal risk assets. And if you want a lot of risk, you buy more of the global equity markets. And if you want something in between, you maybe go 50-50. So the minimal risk asset is an absolutely important part of every investment portfolio, and hopefully now you have a pretty good idea of what that is in your specific case. So thanks for watching. I hope this has been interesting and useful. You can subscribe to my channel if you want to hear about future videos, and you can share this video on social media if you think your friends would benefit from watching it. But in any case, I hope to see you in the next video.